button in the event you'd like to review or go back and review the content. We are recording today's presentation. So if you miss any portion of it, we have access to the archives. Well, again, welcome everyone. As you see, I'm Glenn Thompson. For those of you who haven't attended any of my previous webinars, I've been with Pacific Trading Academy for more than 15 years. You can contact me, at least indirectly, by talking to the people at PTA, Pacific Trading Academy. Here's the contact information, 800-339-8588, or the website. Peter Newman handles all of the subscriptions and any of the information you'd like concerning our various programs. Excuse me. So that would be the person you would inquire about concerning what I do and some of my coworkers, the other mentors. Today's topic is trading opportunities in the aftermath of Brexit, last week's referendum in Europe, specifically related to Great Britain. My previous webinar was, I guess, the 16th, I think, the 15th or the 16th, about 2 weeks ago, where I gave you my thoughts concerning how I would expect the stock market in particular to respond and the capital market sector to respond to the events of Brexit last week. And all I can say as an intro to today's presentation is what a difference a day makes. So on that note, let's begin. And as I said, if you have questions, folks, you can ask them by typing them in the right side of your screen in the control panel. If I see them as I go during the course of the slide presentation, I'll address them. If not, we have plenty of time, I'm sure, at the end of today's presentation to provide a more thorough explanation. Thank you for the feedback. Okay. So let's proceed. This is timing should always take precedence over price, and so my area of market research has to do with market timing, and I typically start in my attempt to generate my views by projecting time targets for the various markets or instruments that I'm tracking. So I wanted to just, for those of you who are new to my approach, essentially, in a nutshell, what I attempt to do is make sense of the myriad spectrum of possible types of things that can occur that I expect will impact the market fundamentally by virtue of looking for agreement points with my time projections. In other words, through various models, I'm able to project and forecast when I expect markets to reverse. I then use that as a starting point to interpret information as it occurs moment by moment, day by day in the world. And I try and look to see where there would be points of confluence or agreement to fine-tune my market forecast. So essentially, that's the quick version of what I do in terms of looking for good opportunities for trade opportunities. Money flows towards the greatest rates of return. We have clearly seen that in response to last week's vote in Great Britain fundamentally, and we're seeing the technical results of charts, some of the intermarket correlations. This is just this is the financial analog of one of Isaac Newton's laws. For every action, there's an equal and opposite reaction, and we see it on every level of in every realm, and certainly in the financial arena. So I take that into account as well. Here, this is a slide that I indicated 2 weeks ago, and this data remains the same. These vertical lines represent time targets for the U.S. stock market. June 22nd was last week, last Wednesday, a week ago tomorrow. It will be 1 week as of tomorrow. And I had, so these are the dates that I have projected relevant to the U.S. stock market for which I project and expect the market would reverse or change. My next projected time point, July 7, and then subsequent to that, the end of July, July 31st, or you could say August 1st. I believe 7/31 comes in on a Sunday, so whenever that happens, I look for the next day that the market's fully trading, which I believe it's August 1st. And then all the way out, I projected September 19 and 20. There's a cluster of 2 days there. All right, so we've already passed June 22nd, obviously was last week. We had the primary fundamental event, the situation with Great Britain, and we know what that's done. This chart doesn't reflect. This was a slide. This was a slide, the actual slide, in fact, of 2 weeks ago. So it doesn't reflect more recent price action. Nevertheless, these vertical lines and the dates that they graphically represent are valid. That hasn't changed. But oh my goodness, how other aspects in the price levels have considerably changed. Here's where we are, and I think there are, as a consequence of the reactions to the event, plenty of opportunities that present right now going forward. About 10 minutes before the close of the day's session in the E-mini S&P, I got long. I re-entered long. I had been long for some time prior to, for a few weeks actually, coming into last week before the events of the Brexit referendum or vote. This top right here, if you can see this, represents the high of last Thursday, right before the waterfall decline that was a direct response to what happened in Great Britain. So my directional change, or my directional call or forecast was wrong. I still believe in the reliability, and I believe that my time projected points and forecast are valid. So right now, where are we? If you're just coming into the situation, if you have been behind, if you were on another planet for the last 2 weeks or so and are wondering what's going on and looking for opportunities, this slide was printed out last night, so it doesn't reflect today's action. This line kind of moving at a slight angle northeasterly represents a zone of overhead resistance. It's currently support because as we have, by virtue of today's trade, exceeded it. We are trading up above it. Right before I got on with you, the S&P was closing, or was getting ready to close. My last quote was about 2026. So if you can see the price axis over here, your vertical scale, right here we were down at about 1996 and 3/4, 1997 area. This is as of yesterday evening, and as of the close, we're right here. If you can see the 2025 area we're kind of right just above 2025, between probably closed around 2026, 2027. And I had just established a new entry to go long at 2026 even, basis the September S&P. Part of my rationale here was I interpreted this line starting from this bottom. This is the low that came in. This was actually Friday's low, last Friday the 24th. The starting point of this trend line this line was low, emanated from the 24th, last Friday's low, and I ran it off of this pivot point low. I believe that was Monday's low, if I'm not mistaken. But this essentially, for various technical reasons in my thinking, served as a zone of a critical barrier, which if the market broke above would be one component or one test that I would put the market to, and if it passed that test, essentially is an indication further movement to the upside is in the calling. So we are trading, as I said, right now probably around 20. I'm not sure exactly where we closed today, but 2026 is where I'm long, and we were so up in this area above this line. So this line now becomes an important demarcation of support for me. So right now I believe that in the tally of all the information I'm taking into account, I believe that the majority of the decline is over. This is oh, by the way, I should mention that this is an hourly chart of the S&P. So I am thinking that this move up, this was a third wave of some degree, I believe. The big move down from the top of Thursday down to the bottom the following day, next Friday. That's a wave, that's a classic wave 3. All of this motion, the retracement up to about almost a 61% retracement of the move down from the top here to here is I believe a wave 4, and then from this peak down through the bottom of yesterday and today, the low point, the lowest point on the screen, excuse me, I believe corresponds to the end of a particular fifth wave. Well, in an Elliott way of thinking of this, if that's the case, theoretically, after a fifth wave completes of any degree, you would expect a correction to ensue. So theoretically, that's part of the imperative I have to go long. And then again, I utilize this line as an overhead previously as what I interpreted as a zone of resistance, which if the market could surpass or exceed, would be an indication I should exploit the long side. Currently, it's trading at about as I said, I went long at just a few minutes before we started talking today's presentation at the 2026 area, and I think it was had gotten up at least to a 2028 as a high for the day. So we shall see. This is just an oscillator that I utilize to confirm as an RSI. So that's one opportunity. If a trader's, and I'm thinking of this not as, these are not day trades, folks. I'm referring to position trades. Also keep in mind the next projected, from the previous slide, my next projected time point is July 7. Whether or not in a simplistic way of thinking of it, what would be consistent with me just getting long would be an indication that I might expect 7-7, this vertical line right here in the date, which corresponds to the date of July 7. So I believe that's about 2 weeks from 2 weeks from now, roughly. Let's see, it's 2 weeks from Thursday. Yes, so 2 weeks, about 2 weeks and a day or so, roughly speaking, I project a run time. So that gives me an idea from a standpoint of factoring in some proportionality. It's just a beginning point as to how long I might expect the market to move on its current trend. And as such, I might be able to work out from a proportional standpoint where I might expect the market to go. But in any case, there are some assumptions that are implicit in that. But this data is constant in whether Brexit had occurred with the outcome that we've seen, or if it had some other alternative had occurred. This data remains constant. And we'll see how reliable it proves to be as we get closer and closer to the respective time points. All right, so this is an opportunity I believe immediately presenting, and again I just established adding to some of my long position. I got stopped out of most of my long position as a result of what happened. Some of it I'm still in, and I'm hoping to, in a sense, dollar cost average. I'm not a big advocate for dollar cost averaging 90% of the time. To some extent, I did some of that, so this may be some of the 10% of the opportunities for which there may be an appropriate, it might be appropriate to incorporate that type of strategy into my longer term position. All right, moving on. I think we have correlated opportunities in the precious metal sector. This is a commitment of traders. Daily chart of silver. It's highly correlated with whether you trade gold, silver, platinum. Platinum probably less, not as likely an instrument because of the lower degree of liquidity. But in terms of silver and gold, either one I like right now. There are some qualifications to that, as I'll indicate. What I want you really to see in this slide is the fact that while we've been rising, while silver prices and gold, this is similar. The chart for gold and silver are quite moving more or less at a similar track. We're moving up overall since this obvious bottom right here, kind of in the middle, right here at the beginning of June. But what I want you to see is that while the price trend is being lifted, it's accompanied with rising strong volume and rising open interest. So that's telling me that, at least in the net, what's partially responsible for the bidding up in the higher metals prices in the precious metal sector in particular is new buyers are coming in versus shorts that are running to the sidelines. Liquidations tend to be higher velocity phenomena than new phenomena. New phenomena, establishing new positions, tends to be a longer lasting phenomena, and as such it lowers the degree of risk attendant with establishing a new position. So I am biased towards, I have not yet entered the market in any way, long or short, but I am anticipating and have a bias, I would say about 60% favoring the 67 to 70% favoring a long position currently in either silver or gold. As a contraindication, we've got a net short position by the red line here, the commercials. They're close to a large net short position while the spec position is net long. The problem, why I'm still convinced that the more profitable opportunity lies on the long side of the metals, at least for this period right for now, is due to the trend and the fact that the trend is being supported by rising levels of open interest and volume. Also, this red line, this is the 50-period moving average. We've got the price action. We've got 8 and 21 moving averages above. So from an overall trend standpoint, the momentum is, I think, is clearly to the upside, and it's going to take some countervailing issues and forces, I think, to turn that around. So I think the smart money, at least for the next few weeks, to the extent I see, we are still in the aftermath of this British vote. We will see, for a number of different reasons, both fundamental and technical, further appreciation in the precious metal sector, i.e. gold and silver. So the next slide indicates a little more precisely how I would play this. I tend to trade silver more frequently because it's more volatile. I get more bang to buck out of it. But I would be in, this is the July contract because it's a little more liquid at the moment, were I to actually, if and when I play this, I'll probably go out to September for expiration reasons. But these horizontal lines represent zones I've projected via different models of support and resistance. So if we close on a closing above this uppermost horizontal line, so you can see that's just under $18 per ounce silver. This was printed out last night. I think as of the, right now, about 10 minutes ago, before I started today's presentation, the silver contract was trading at $17.82 roughly per ounce. So again, just above the 18, or just under rather, $18. So if we break a close above $18, certainly that's gonna go a long way towards initiating long positions in silver, one way or another. So that's that's one of the conditions that I will look at. From an Elliott wave structure, I didn't bother to put the count here and illustrate my labeling of where I think the market is, but I believe we are in an impulsive portion of a market cycle in either gold or silver. And again, as a final test in combination with certain oscillators that I use, on a break above this upper horizontal, which is just, it's about, what is that? 1750, 60, 70, 80, 90, about 1797 area, somewhere above there. On a close above that, I'll, in all probability, look to establish long positions in silver. Whatever the corresponding price level in gold, for those of you who prefer gold, either one is acceptable. I wouldn't do both. I would do one or the other because of the high degree of correlation. From a fundamental standpoint, to the extent there is an exodus out of paper assets, especially the stock market in the U.S., I expect some of that capital to end up in the metal sector. The first stopping place typically is in the interest rate market, in the bonds, and we're seeing significant appreciation in interest rates in the 30-year Treasury and the 10-year note. That's further aided and abetted, I should say, by the hesitation for whatever set of considerations that the central bank has had in raising rates, even though they have continued for the last 6 to 8 months now to indicate we are going to be raising rates. They have qualified that. The caveat, the working caveat here is our monetary decisions and when the timing of said interest rates should be informed by data, or data-driven. So given to the extent we see weakness in the equity market and overall in the data that comes out, jobs, etc., unemployment reports, etc., consumer confidence, all of the normal laissez-faire economic data, we may see a hesitation on the part of the Fed to raise rates, and that is further lifting the nominal bond price. And to that, so that's in a direct consequence to a flow or an exodus of money coming out of equities and moving first into the treasury markets and then secondarily into the precious metals. So we've got a scenario where the technicals on the chart are lining up with a series of fundamental factors that make sense, thereby improving or spreading out the odds for success in a long entry to gold or silver. All right, so that's another discrete trading situation. So first and foremost, I do believe that it is appropriate now if one is on the sidelines, to establish long trades in stocks, individual stocks. We may begin on a selective basis, stock by stock, or the stock index. I trade the E-mini S&P, any specific U.S. index. The Dow, the NASDAQ, the Russell, Spiders, SPY, or ES, I think would be appropriate instruments. And correlated with that, gold and silver. Just for those of you, thinking that there may be an implicit contradiction in what I just said, because I was saying if funds come out of the stock market after, that would tend to bid up the price, so you might be expecting further declines in stocks. Yeah, but they're out of phase, and there are periods of time when you can have both the stock sector and the precious metal moving in tandem together. If we continue, if I'm wrong about my forecast and projection for stocks and the broader stock market, and we turn around and the market and there's more downside to come, let's say, then I would get out of my long position in stocks, and I would expect, to the extent that further declines in the stocks at large were to persist, I would expect clearly that would bid up the price of silver and gold. So even though that's not what I'm expecting right now, that's a contingency scenario that I'll talk more about as we get in the final slides. But for the moment, there are scenarios, and I think in direct response, even though the stock, I anticipate and project stocks to rise from here, and again, my time horizon is between now and, say, at minimum for the next 2 weeks, corresponding to that July 7th time point, I still expect it's possible from a fundamental standpoint, it's still plausible to expect silver and gold to rise commensurate with my expected appreciation in the paper sector and equities. All right. Completely different sector, soybeans. And so there's a very interesting correlation between inflation and bean prices. I find this fascinating. I learned this years ago out of trading Forex and trading currency pairs, and certain trader, one of the traders I had the pleasure of learning from many years ago indicated this, although maybe not superficially apparent, a very important correlation between levels of inflation and soybean prices. And as such, you can indirectly, there may be some other associated correlations. Look at you can see we've been rising clearly since the end of the first quarter through the recent top in this month in June, and then we've had a little bit of a pullback. I am looking to go short. I believe we have a crop report coming up like tomorrow or in the next day or two, and I expect, based on my assessment of the fundamentals, I expect declining prices. I think the supply relative to the speculation is going to weigh on bean prices. This also works in concert with a lack of economic data suggesting any real indications of intrinsic inflation. So I believe this is a play on the correlation with inflation, on the fundamentals impacting the soybeans supply and demand actual levels right now relative to speculative forces that were responsible for bidding the price up to overbought what I think are intrinsically overbought levels, and as such I expect a rebound. Currently we're in an up bias if you look at all the two moving averages, the 21, which is the green line, the 8, which is the blue, and the price itself relative to the 50, but I'm seeing a decline in open interest and a petering out of volume. And so also if you look at the red line down here in this commitment of traders, this may be a point where for the commercials, having been at their largest net short position for going back at least the last 6 months, sometimes that alone it doesn't tell you anything about the market timing, but I've got some indications to suggest that from a timing standpoint the market is ready to turn. I believe this move from the top down to the bottom 3 days ago is an initial wave, and the move up is possibly a correction to that initial wave. So I'm looking for some type of degree of retracement from which we can even sell it from a slightly higher level. Either way, we'll see. The next slide indicates this a little more precisely. This is the daily chart of November soybeans. So I've got a Gartley here, or the Fibonacci degrees or amounts of retracement that correlate with what we refer to as a Gartley amount. So from this top right here, the highest point on our soybean chart, down to the bottom of Friday's low. This you can see if you can. That's a little hard to. I can't even see it, so I doubt you can see it. But we were trading. That was at $11.19 or so, or just. This was printed out last night, and we got up as high per bushel. This is dollars and cents per bushel if we're talking the real futures in soybeans. That's how they calibrate it. So we got up as high today as right before I could, unless something happened, up to 1136. So we had a significant bounce up to the upside today. If we get up into this area just above, 1143 area, that's corresponding. I'd optimally love to see in the next day or so a move up into this range between what would be a 61.8% retracement or all the way a maximum of 78.6 of the preceding move from the top down to the bottom. If we get that or approach that, I'll be looking to go and establish a short position in the beans. I would do November beans. You see. Now, if we fall short of that, I think the current high for today corresponded to like about a 38, somewhere between a 38 and a 50% retracement of the move down. This initial, what I consider to be a leg down. This move down is either an A of an ABC correction, or it could be, this could be an end of a fifth and the start of a new bear market cycle. In either case, I expect the overall direction of prices for some time to find a new equilibrium at a support at a lower level. And so if we see a further appreciation or bidding up of the bean prices in the next few days, consistent with the crop report that's scheduled to come out, I think either tomorrow or the next day, I can't recall exactly, that could, if we see any discounting of that and get close to this range, I'll clearly be looking to sell from that higher price. If, however, we've seen the maximum degree of retracement of the initial move down, I'll sell a breakdown below this bottom right here, below Friday's bottom. Either way, I've got a contingency plan to go short, and I think that's a 75% probability for a profitable outcome here. And it has as its foundation a correlation with inflation, a supply-demand component, and also indirectly a response, very indirectly. You may say, well, what does that have to do with the vote in Great Britain? All of these things are one way or the other. Some are more directly connected, some are less or more in ways that you might not immediately observe, but indirectly are connection. Okay, so that's the soybean trade. This is another scenario. Let me just stop, folks, in case there are any questions. Any questions thus far? Let me just slide. No questions so far, so good? Are you still okay? We can see clearly. Every now and then past webinars have given me the experience that I should check in intermittently to just make sure you have audio and visual. I think about a year ago I did a presentation. I got through 75% of it, and people couldn't, it wasn't technically valid, so it was kind of for naught. So I always am a little cautious, but very good. As long as you guys can hear me and see the screens, if you have any questions along with what I'm presenting, please feel free to interject. If not, save them for the end and we'll address them at that point. All right. So moving on, another play. Fundamentally, let's just think about this. There has been a flight out of Europe, and the British pound, GBP, USD in particular, the British pound, significant decline and pressure on pound. There's a lot of uncertainty still. It remains to be seen. The consensus of the longer-term view in terms of what this does for the greater European EC, the European community and union, and Great Britain in particular, but at least in the direct response, we've seen considerable pressure on cable, on British pound, USD. And as such, correspondingly, we've seen a bidding up of the US dollar price. Well, a few weeks ago, I got short in oil based on certain technical projections. I believe to the extent we see appreciation in the US currency for a number of reasons, partly due to Brexit, direct consequence of this, because oil is specifically priced in, as many commodities are, but oil in particular, priced in US dollars. To the extent we see the dollar go up, I expect falling that to put pressure on oil. That's not the only reason, but you see structurally here, we've seen this could be considered an important top. If it's an ABC correction, this would be the A, this line here, this could be the B, and a C. If it is, it's already showing indications, the structure in the chart conservatively speaking, it could be what we call a zigzag type correction. If it is the C wave, this move from this top down to where we ended up yesterday, this is printed out last night, would it conservatively get you down to the 44.5 or at least $45. So we set right before I got on the line with you today for today's presentation, oil was trading, if I recall, about $47.91, just under $48 per barrel. Conservatively, I expect a $2 to $2.50 decline down to the $45 area. More ambitiously, we could drop, and so this 100%, these two lines, 100% extension of this initial wave from this top right here down to the bottom right here. If the market were to have a duplicate or a replica of that move starting from this, projected from this more recent top, that would bring you down into the between $44.50 and $45 even per barrel. That's conservative. So as a trade, if we get in right anywhere in here currently, I expect good opportunity. More ambitiously, if we have a deeper move, the lower horizontal represents a 1.618 Fibonacci extension of this entire move, and that's going to bring you down into just below $41 per barrel. So you can do the arithmetic and see the opportunity if you feel it's there. From a reward risk standpoint, I feel this is a valid entry, and to a large extent it would not only technically it's valid, and there's a rational technically there. I didn't put the wave count here in my projected time points, but I've got run time expect further out into the end of August corresponding with this. And that's not to say the market is going to move straight down into for between now and the end of August. Certainly not. I expect back and forth motion, as typically is the case with most financial instruments. But overall, I expect, again, conservatively, another $2 to $2.50 drop from current prices, and we're trading again, as right before I got on with you, at about just between almost just under $48 per barrel oil. And so I think great opportunity, and this is a trade that I'll be looking to enter. And all of these trades, again, folks, bear in mind, I'm anticipating are position trades. I've done other programs, I short-term trade, day trade, intraday, etc. But these particular plays have the context or time horizons consistent with longer-term positions. All right, so that's another valid entry, and the details of which would depend or should be informed by the specifics that define your account, what your level of resources are. Do you do an option play? I'm just pointing out what I think are some good high-value probability scenarios based on the technicals, and also take into account directly and exploit the situation in the aftermath of Brexit. All right. So moving on here, next slide. All right, this is another view. This is just the stock market chart. This is the E-mini S&P, the September contract. Notice we had tremendous volume, this big red thing on the big portion, that what I call a third wave, clearly. So this is just, I wanted to show we've had a decline in open interest, though, a petering or a stabilization or a plateauing in open interest. So that's one component. That little purple line going flat or horizontal is an indication that I think, for the most part, either I came to this conclusion yesterday, we're either at a significant bottom, or if we're not, we're nearly so. From a wave count perspective, from the standpoint of allowing just the proverbial dust to settle, if we're looking or thinking and interpreting and conjecturing this in a context of fundamentals, clearly we have a mixed bias. The price is below the 50-period red line, moving average here. The 8, the shorter term, my 21 is still above. So it's a point of indecision. I expect to see some dojis for those of you who are candlestick aficionados and enthusiasts and apply that. But we've got a commercial position which is still net short, but it's moving up. The speculators, large and small, especially institutional money, is net long. That's bullish. I don't think the bull market is over, is the point I want to make, due to a confluence of considerations here. If otherwise, I would not have reestablished my long position at levels that were kind of much inferior to where they were a week ago this time. So also I thought of this morning and I just didn't have the time to include a slide, but just for your information, from this bottom right here, this was kind of in February, I think that was February 11 or 9th if I recall, for the entire move, wave 2, you know, this is the 1, 2, 3, this is your 4, this could be a 5th wave. Or this could be the 5th. That was the count that I indicated 2 weeks ago when I met with, you know, in a webinar. You know, as conditions change, what do? We must adapt and be flexible and adjust with them. But nevertheless, the initial portions of that description I think are still valid. But here's my point. If this is the lowest point on the screen, either this bottom here or this point right here, if you measured the range from this bottom right here in terms of nominal prices up to the top, the highest point on the screen, okay, the amount of pullback we're kind of right at the reason. Technically, one could say this is a Fibonacci retracement. It's 38%. I forgot to I saw that and I literally did not have time to include that, but if you just measured a vertical line from this bottom in price, you did simple subtraction. You measure the high price here, subtracted the low price from that, and you take 38% of that number and subtract it from this high, you'll get essentially this low. It's more or less, we are in and around for the last 2 sessions and dancing in and around this low at 38%. I would submit to you at least that is a major reason. It's not pure coincidence as to why the market stopped at the level that it did. It's respecting that 38% Fibonacci zone. Okay. Now, this was as of last night, 1997.5. We have sensed, again, we broke through a zone of what at the time, as of last evening, was overhead resistance. We're trading probably, I think we closed in the day session day about 2027 area. And again, I'm long from 2026. I still believe it's a viable opportunity. Any one of the major, this is basis the September E-mini S&P. So I like and expect appreciation. I am not certain where we are, how this fits in a description, but again, I believe we have seen possibly a 5th wave and a completion of a major move, and as such, we are due for a move to the upside, and that's why directionally I've established a long position. Okay, so moving right along here, I can advance the presentation. All right, so this is a recap of the time points that we have here. All right, and these are still, this is past the June 22nd time point. These are the rotations. My next projected time point, again, 7/7. Subsequent to that, the end of July, I think 7/31 again comes in on a Sunday, so this is one and the same as August 1st, let's say, and then going further out, not of immediate impact, but certainly as we move towards the end of the summer, I will be interested in what the market's doing. Again, folks, these lines intrinsically don't inform us in any way, shape, or form as to whether or not, even if in fact they are valid, prove to be reliable forecast as to timing trend reversals. I don't know at this juncture, at the time we're talking in the present, whether or not they will in fact correspond to tops or bottoms, assuming that they are in fact, or assuming rather that the market in fact does exhibit a sensitivity that creates a reversal. I don't know at this juncture. It's reasonable to assume, I always tell traders that I'm consulting and working with, that when you generate a time point, as you get closer and closer, you can make assumptions, assuming the trend is moving in a given direction or another. If it's moving higher, the closer you get, or more proximal you get to a projected time point, the more reasonable it is to assume it would form as a top, or vice versa. If the market's falling as it arrives at a turning point, reasonable to assume it would correspond and manifest a bottom. But those are assumptions, and we have to always be aware that there could be phenomena that skew that interpretation. So we have to be aware of that and allow for a spectrum of 360 degrees of possible outcomes of behavior. All right. This final slide. My forecast going forward, this is the same chart, but oh, wait a minute. This is not this is the forecast that I generated a week or 2 weeks ago I had and presented pertaining to what I was expecting to occur last week. Well, again, coming full circle, what a difference a day makes, and following through where we are a week ago from, or about a half a week out from Brexit. I was projecting, let me just go back to the previous slide just to give you context. I thought that this was the end of a fifth wave right up here. If you can see my mouse, let me just make sure you folks are following. This is a little detail. Sometimes the devil's in the details. Can you still hear me, folks? Make sure everyone is still there. All right? Okay. Okay. All right. So again, this is one up here. This is wave 2. And I thought that somewhere in here, this is 3, A, B, C. This is your, oh, wait a minute. This was the 3, excuse me. And this was the top of a fifth. This was an ABC correction. I thought this bottom right here was the, and let's see if I can get the screen, that the bottom, in, I believe this was May 19. This bottom right here was the end of an entire cycle that began back at the beginning of the year in January. 1, 2, 3, 4, 5, ABC. Again, 1, 2, 3, 4, and 5, A, B, C, and then thus the end of one cycle marking the onset of a new bull cycle. I was figuring 2 weeks ago this could be wave 1, and the reason the market was pulling back into what I was projecting last week, corresponding to this turning point of June 22nd, I believe the market would continue possibly falling into the 622 point and then begin its march upward in what would be a wave 3, the largest part, and as such I was long. Well, as it turned out, I had the right idea up until, say, Thursday afternoon, last Thursday, the 23rd, or yeah. And then things departed from there was a quick and abrupt and decisive departure from my forecast. It is what it is. I'm wrong sometimes. I still believe I'm correct on the timing, but I was clearly wrong in terms of the direction. I had projected the market would move down into 622 last Wednesday. Well, I had the right idea. It actually stopped its decline. This is, I think, it started going up prior to last Wednesday and moving up. So we were making money. I at that point interpreted the market as just it arrived, or the market moved quicker, or my time point was a little behind what I was anticipating to occur. Given what's occurred in the last week since Brexit, this was my scenario that I presented to the participants and people who came to hear me speak on the 16th of the month, 2 weeks ago. I expected that this bottom, this vertical line, June 22nd, would correspond to the end of a correction wave 2 and form a market bottom, and then we would move higher into a new high, actually. And I had actually worked out price targets. If you can see that, for your information, for those of you who weren't here 2 weeks ago to listen to me speak, I had conservatively estimated a price of about $21.90, and that would certainly be a record high for the stock market in the United States. And then a correction wave 4, taking you down to the area of about between 21.30 and 21.45, or 21.30 and 21.40, and then out into the fall for what would be what I was estimating and conjecturing could possibly mark the end of the long-term multi-year bull market, and then it collapsed from there. Okay, that was my hypothetical forecast 2 weeks ago. Well, again, what a difference a day can make. This is where we are, and this was printed out last night. It doesn't reflect today's activity, but again, the dates, and I've left in last week's date just for the record, but this is the next point. We have been moving down into my next projected time point, July 7th, which is this the first blue line on the left that you can see here. It's corresponding, this is 7/7, this is August 1st or July 31st, and then the one out in the fall. All right, so I've adjusted my wave count. Previously, 2 weeks ago, I was thinking where number 3 is, the end of the fifth wave. I thought that was I thought number 3 here was number 5. This was the ABC correction, and this was new wave. This was the way where I have 5 here. I thought that was the new bull market end of wave 1, and we were coming down in what would be correction wave 2, and we would go up in what would be 3, and that 3 would persist all the way over to this first blue line. Didn't mean to press that. Okay. Well, I had the right idea up through again yesterday evening at about 5:30 Pacific, I imagine, and then that's when the world came apart. We went into collapse based on an event in the world. We know it as Brexit, and things collapsed as you see. So the question remains now, how do we fit what has happened, the real world? The real world is always correct. It's the standard reference by which we try and figure out what's going on, the current state, and push and extrapolate that state out into the future. But is this, if this is wave 5, is this an A, this little move down, and then the move up into last Thursday's high before the outcome of the vote? Is that an ABC correction? Or is this the A, the B, and then the C? In which case, that would be a logical, if that's a wave count, in other words, I didn't label it, but if from the top that came in here, what I'm labeling wave, the end of the 5th wave of the set of, from the bull market cycle that's began back in January of 2016, if that is the end of the 5th, it's possible we have structure that is mapped out and traced out on the screen since this top of this peak here in June, down to this bottom here, that I believe was the May 19th bottom, up to the top of last Thursday. If that's an A and the top of last Thursday before the collapse is the B, then the move down would be wave C of an ABC correction. And a logical explanation or for why the market would move up, it would be the start of a new bull market cycle, i.e. a wave number 1. And that would make sense. It would reconcile the chart, the structure we're seeing, with the events in the world. So we have to take that possibility into account. There's an alternate scenario, and so that scenario is clearly bullish. However, just, it's not the only one that exists. There are a myriad of possible scenarios that don't break any rules. It's possible that if this is the end of the 5th wave, the market just clearly foregoes the bear market. This could be a wave 1 of a new bear market cycle. This would be a 2. Now, the reason I don't favor that is because if I assume that's what's at play here and what's motivating and driving the market, you break a rule. For those of you who understand Elliott, the principle, if this is the end of a 5th and the start of a bear market wave 1, if this would be 1, you shouldn't have a 2 that takes out the start of 1. So for that reason, that would be a reason to not favor that description. If I make, because of the actual particulars as to how the market formed relative to a theoretical model that says you should not have the end of the second correction, wave 2, exceed the start of wave 1. That said, if I'm willing to overlook that, in other words, on the premise that this is the end of the bull market and it just is so weak that it foregoes the correction, but it moves directly into an outright trend reversal, an outright reversal of generic. We move from a sea change, from a bull market to an immediate bear market. And this is 1, and this is a 2. And if I admitted, it's not that egregious a violation of the rule, if I turn my head to that and don't pay and allow for that transgression of the theoretical aspect of that model. And why might I do that? Because of the power of this move. Everything from Thursday's top through the bottom that came in on Friday is very third wave-like. It has the power, to quote Elliott, third waves are wonders to behold. It clearly is third wave in every respect. One of the peripheral ideas that accompanies theoretically how third waves set up is there should be an event or a series of events that is in an obvious sense known. Well, clearly this has third wave written all over it. What happened from the top of Thursday through Friday morning's bottom, the bottom since the top of Thursday, is clearly a classic third wave type structure. Whether it is or not, I am not certain, but it clearly, you could make a case for that. If that were the case, and in fact, if it, if it's just the third wave, it still would be a shorter term play. I would still expect appreciation on the assumption that that third wave is complete. Why? Because you'd expect a fourth wave to go up, but that would severely or clearly dampen my bullish enthusiasm, because fourth waves in general tend to be rather shallow. They don't tend to be large, in a scale sense, big moves. But at least directionally for the time being, I would expect appreciation on the assumption that even if this were a third wave that were responsible for the decline, and the fundamental thing we peg our hat on as to what caused it was Brexit. If it wasn't that, it would have been something else. If that in fact is the third wave, that would dampen my bullish enthusiasm. I would still be bullish to the extent I expected that the third wave was over, because I know theoretically the fourth wave must form, or should according to theory. But it would limit my ambitiousness, or the ambition or the projections to which I might expect the market to move higher. And so the time frames still are valid, but they would, and so it's still a reason to establish a long position if you expect that's the case. I'm not certain, but I've graphically illustrated. This was my scenario 2 weeks ago. I was expecting the market would go up, establish a new high on or around July 7, pull back into the end of July and what would be correction wave 4, and then establish the final impulsive move up into the fall, the fifth wave. If I'm wrong directionally about that, if this is not a ABC, let's say we're not the bullish scenario, plausible wave count. Let's say if this is the end of 5 and this is not an A, this top here, the start of Brexit, is not a B, and the end of Brexit, or the immediacy of the move, is not the C, and we're not in a new bull market, because if that scenario is at play, the reason the market would go up is wave 1, a new bull market cycle, and that would certainly have more stronger bullish ramifications than if this were a bear market, clearly, obviously. In either case, I expect the immediate move, and when I say immediate, my window of time is for the next 2 to 3 weeks, let's say, to give myself a little margin of error, to be congruent or consistent with this 7-7 window of time, plus or minus 2 or 3 days around 7-7. That's the run time for which I expect the next major course or trend to run within. Whether it's moving up because it's a wave 4 of a current bear market that began over here, if we allow for this, what I would say in the scheme of things is a minor transgression of the model wave 2 took out with the start of wave 1. In either case, I still think we can make money on the long side currently for the next 2 to 3 weeks, because it would be forming wave 4, or more optimistically, if this is the end of the fifth wave, and this is an A wave of an ABC correction, this is the B, and the bottom here that came in on the bottom of the move is the end of Brexit, immediately is the C, then we would go up and be what would be a wave 1. The magnitude of which would be more challenging theoretically to forecast in advance, but at least directionally we'd have to use other hints and clues from the market, but we at least have a time window based on this vertical line corresponding to the date of July 7 to cue us as to how and what types of adjustments one might make to that long position. So I've graphically, this was my original forecast 2 weeks ago of what I was expecting. I have graphically painted in or drawn in the mirror image, the upside down, in the event we're in a bear market. In the event that there's still a valid, I can depend on the time points, it would just flip the rotation such that if this is, I might expect either this move up to go up in what would be wave 4, or it could even, if we're still in wave 3, or maybe the fourth wave is so brief it's over, we could even slide down for to lower prices, certainly for the next 2 weeks. I don't think that's the case, because I just think, in consideration of all the bits and pieces of information, be they fundamental, quantitative, technical, the plethora, the confluence of all this input does not suggest fundamentally, clearly to me, in my gut, that we're going to see that degree of a retracement of the entirety of the move that began at the beginning of the year. It could. It's not as if, I'm not saying it's impossible. That would correspond with a deeper degree of retracement. And we'd still end up, if we were down here by the end of, moving out into the fall, we still would be up on the year, let's say, relative to the start of where we were in January. But that would just correspond to, and that would portend much deeper degree of Fibonacci retracements or Gartleys or whatever. As I said, the current level, if you looked at everything from the lowest price back in February or January, take your pick here, up to the top that formed last Thursday, corresponding to the height of the stock prices prior to the release of their British vote, that we are right here at a 38% Fibonacci degree of retracement of that entire move from the bottoms back at the first quarter of the year. So for that reason, I expect more probably we're going to go up. I don't see the bearish scenario playing out, but I could be wrong. Even if I am wrong, I have confidence. Even if we are in a bear market, we would be in the fourth wave, which would serve to bid the price up, at least in the next 2 to 3 weeks, I expect. Remember, fourth waves tend to have a longer run time on average than any of the other portions of a market cycle. So for that reason, it's not the biggest bang. It's certainly not in the favored portion of a market cycle, but I think just the again, every action having an equal and opposite reaction, I think we're oversold here significantly. A lot of this move was, I think, there was a feedback of fear and market sentiment where people just panic. And we see extreme moves, and that's especially in third waves. A lot of it is sentiment. There's an irrationality that accompanies, and to a large extent, is a major propellant, especially in wave 3. So, any questions, folks, on any aspects? I'm not sure if you followed me, folks. Okay. Any questions at all? All right. I think that, well, if you have questions, I'm a little surprised. Let's see. I want to make sure you guys are there because I'm not seeing any questions. Let me just scroll this thing here. Bear with me, folks, if you can hear me, and as long as you can see, I'm not seeing the questions. Normally, it's very odd, so that's why I'm suspicious that maybe there's a technical. Okay, I'm seeing you can hear me, but are there any questions whatsoever? That concludes our presentation, and normally okay, thank you, Rob. USD, well, I didn't have a specific trade for the US dollar. If that's what you're referring to, if you're talking about the dollar index, because now if you're referring to forex pair, it would vary depending on the particular spot currency. But for the dollar, I did not indicate. I made a point earlier in the presentation. I do expect appreciation in U.S. dollar prices. Just think of it this way, as a currency of flight. Curiously, a lot of funds, there will be money leaving Europe. And folks, for those of you who have not heard a presentation previously, if this is your first encounter with me and the type of analysis I do, I am a technician first and foremost. I want to present that and state that explicitly. Brexit was a special event. I will admit to you, I was caught off guard. I did not expect that the markets would respond in either, whatever the outcome was, and I was certainly expecting that Great Britain would maintain a laissez-faire status quo. I did not expect. I was surprised by the vote. You know, early Thursday morning, a week ago, I was getting reports and reading just out of curiosity because, again, I don't do my analysis primarily starting with fundamentals. I'm 80–90% technical. And then I look, but because of just wanting to stay abreast of the events, I was reading all the information I could. Early on Thursday, I was hearing reports that there were about a 94% probability that Great Britain would remain as a part of the European Union, and I felt confident in a long position and holding on to my bullish view of the stock market in the U.S. at least. Again, not only what a difference can a day make, but not only a difference an hour or so, a few moments in a relative sense can mean. So. In light of and in response to the impact of such an event, whether I recognized it before, I certainly recognize and acknowledge it now, subsequent to the event. Clearly, I don't want to not pay attention to the capital flow and monetary motion and the flight of capital, if only for that reason. Even if we did not have an accompanying technical backdrop to support my expectation for U.S. dollar appreciation. Clearly, there is a portion of funds, foreign funds coming into the U.S. dollar. The fact that the Fed has delayed raising interest rates, they're certainly not going to lower interest rates. I mentioned last time, 2 weeks ago, that we've got in Germany negative interest rates. We're in a heightening environment, the monetary policy. The Fed is just looking for an excuse to raise rates, if possible. I said 2 weeks ago that I expect if we have the slightest bit of economic data that would be supportive of such, then I believe in July or before the summer is out, because I don't think that the the central bank wants to raise rates as we move into the fall where we have the election. I think, well, you know, first and foremost, their theoretical mandate is to support employment, maintain and regulate, you know, keep inflation under check, price stability, if you know, a target of 2% inflation, and maintain longer-term interest rates stability so as to prevent inflation. But that's their ideal mandate. But in the real world, they have a political consciousness. They are aware of what's going on and the ramifications in Asia and in Europe in particular. And as such, what happened last week is significant. So even if the Fed delays raising interest rates, and by the way, you know, we're talking a quarter of a point or whatever, 25 basis points, whether, you know, or whatever the frequency of additional rate increases might be between now and the end of the year, even if we delay it or it's not as much as one might expect, just based on the reaction to Brexit, I might expect a dollar bidding up. And so, yeah, I didn't state that because I had just literally hadn't had a, here's why I didn't do the dollar as an explicit trade. I trade Forex, so I would trade the dollar, I personally would trade the dollar indirectly relative to either the Great British Pound or dollar yen or dollar Swiss or some of the currencies. If I think for my money at the moment, there are more indirect ways to trade in response to what happened fundamentally in Brexit, also because I know the dollar index is a less liquid contract, so for practical factors. Is it a good play? Yeah, but I think indirectly the way to exploit the dollar is to go short oil based on the correlation between energy or oil prices. There are other factors I didn't elaborate on, but oil I expect to go down for other fundamental reasons with OPEC and the situation, just world slowing the economy and supply-demand considerations, all of which are fundamental. Even if I didn't have it, I believe it. The energy market, or crude oil in particular, will be a beneficiary of stronger dollar prices and be offered down. And so I think that's the more direct play to exploit what I expect will be a bidding up of the U.S. currency right now. So hopefully I at least to some extent addressed your question. Not that I am bullish the dollar for the moment, for a host of factors, but I think rather than it going and buying dollar or going long into dollar directly, I think there are some indirect plays, i.e. especially the short in the energy sector, oil in particular. If you're trading on the security side, you trade ETFs. There are just funds that are quite liquid. What is it? OIL is a good one. I think USO is another pretty liquid one. Great. Oh no, I heard someone saying you're a Forex guy. I do most of my 80% of my personal income in Forex, and then I also day trade the E-mini. But for anyone on the stock side or security side, as I meant, that's why I said there are individual stocks. If you like trading stocks that, to the extent they are carried along by the sentiment of the broader index of which they're a part, you can trade those. But if you're on the derivative side, or if you're not familiar with derivatives or futures, let's say, there are typically ETFs that track some of the underlying, like gold, silver, there's SLV, GLD. There's a spectrum of pretty decent ETFs that you can do if you're on the security side. If you're on the derivative side, you can trade the underlying, or you may not. You may do an option play depending on your specifics. That's the money management stuff I haven't gone into today, but wanted to more or less present an overview of expected high probable, high value areas that directly are in consequence of what I'm seeing in the aftermath of Brexit. But certainly, first and foremost, as a rule, I do the technicals. And for me, those of you who have listened to webinars that I've given in the past, my trend analysis is number one. A close second is my market timing. And then I look at the descriptive models such as Elliott and then on down from there. There's a myriad of things. I've been trading for 34 years, so I have at least a peripheral, you know, Ichimoku to, you know, Heiken Ashi. Someone asked me about Heiken Ashi the other day, and it's a Forex trader. And I said, yeah, I used to use it. I've forgotten, so I have to run up. There's so many different things. There's an infinite number of things. So what we typically do is we want to focus in on the 5 or 6 different things that are very different, that primarily you've tested and back tested, and you know you're getting good results, and then on from there you do your analysis. Let me see. Any other questions, folks? On NES, oh yeah, I don't know why I missed now. I missed some of the questions. Can I look at the wave count for USD? Yeah, I had a chart of that. I just didn't have a chance to put that in. I don't recall the wave count. I do, but I need the chart. I don't remember the actual dates on the USD, so I'm sorry. It's easy. It's a pretty obvious wave count. I just don't recall it at the moment, and why why I think you know, what the wave rationale for why I expect higher prices. But there is one. I guarantee you that. I'm aware of it. I had a lot of good ideas this morning, and then I was involved in consulting some traders and literally did not have time to get some of the slides that would have further embellished today's presentation. Plus, I got a little sick a couple of days ago with a cold, and it just kind of slowed me up here. So, yeah, but certainly as a verbal response, I expect appreciation in the U.S. But again, the immediate trades I'll be looking to do shorten oil. I'm long. I just got long earlier today, about an hour before, or a little before the market closed in the day session in the stock market in the ES. And then the other trade I'll be looking to establish most probably a short in this bean if you're in the agricultural sector. And then the other one, based on, let me just quickly review that slide there, in the precious metal sector, gold or silver. Let me just go back on a break above $18 in silver. That's your, just quickly show that to review in case, this is the oil short. Here's the silver chart again, folks. This is my, oh, I'm sorry, this is the wrong chart. One more back. Two back. Yeah, this upper horizontal is just below $18. We got up above, but I think we didn't want to close. I want to close above this upper zone of resistance. These are some GAN configurations that I worked out here, but this is, suffice it to say, these three lines are zone. This is a zone of support. We break down below that. I'm off, but a close above this upper horizontal, and that's just below 18. Again, so gold's closed probably around $1,317. $1,317 is where it was trading right before I began the presentation today, and silver was at $17.82. So when we get up close above $18, I'm going to establish a long position in silver. Contingent on that, though. If it doesn't happen, then I'll hold off and monitor it based on a number of factors. Okay. Let's fast forward to the end again. Okay, folks, if so, let me just see one final check if there are any. What's the probable signs, someone's asking, of next major move up or down? Good question, very good question. I'll be honest, fear. You know, the two major markets tend to go down, and it's almost a cliche. I think I almost expected last Friday at the close to see follow through on Monday. Very often when you have big moves down on a Friday in the stock market, there's the pent-up momentum, and it's almost as if a battery storing up all that potential, and all the selling that didn't get released on Friday by virtue of whatever, a time restriction or whatever, just the emotional fear. And they've done study after study over the years that show traders are, you know, the two primary motivating factors that create trades in markets are fear and our desire for profits, or greed in the extreme. But they've actually done studies that show that the component, the starting catalyst for market traders' decisions, for fear is 2.27 times more powerful a factor. I don't know how they do these polls, but then our desire for profit. In other words, traders and in the net, they've studied and showed, and the polling shows, are more fear-driven. They are we're risk averse more so than we are profit seeking, and that's an oversimplification. But but it more or less indicates the macro picture of traders at large. So traders in fear, that not only fear of outright loss, but fear of missing profit opportunities, money opportunities. So I think a major catalyst out there, if we look at the collective sentiment of traders worldwide, what could propel or continue the downslide is just further fear. If we see the slightest, you know, due to the world 2016, the interconnectedness of information and the speed with which and velocity of flow of information and transactions worldwide into the world today is such that if we see in the next few weeks disorganization, and we see that Great Britain is not removing themselves and the dust is delayed in terms of settling, and to the extent we see, for example, that their exiting from the Union serves as a contagion and other nations follow. I'm not saying that will happen. I'm not saying it's not. I'm just saying probable types of events that could serve as catalysts to bring about further progression or persistence of moves. So on the bearish scenario that I was last explaining, if I go back to that, where is it? To that, where's my, yeah, if I go back to that, yeah, you know, if this is the end of a 5 and this is a new bear market 1 and this is a 2 and this is a 3, then the little move up I'm expecting could just be a correction 4, and then we could slide again. If we're current levels are at 38% Fibonacci, and this could guard, this is, I can look at that and sell, that's a Gartley, that's at least, that's about 60, somewhere between a 61.2 and a 78.6 fib level of the entire move from the beginning of the year to Thursday's top. And so there's technical rationale as to how that could occur, and certainly we see some disorganization in terms of the aftermath of the referendum last week. That type of event could occur. It could be, now on the one hand, on the other hand, it could be something, a universe apart. You know, for what should I say? I hate to say it, I hate to bring it up, it's such a negative. The higher frequency of, in the last few years, with which we've been experiencing terrorist attacks in the world, most recently in Orlando and Florida, you know, anywhere in the world, the Paris attacks before that, the issues politically. I think the next big thing, you know, on the horizon, an obvious fundamental event coming up at the end of next month, the political stuff here in the United States, our conventions. The situations, are you a Trump supporter? Are you a Hillary? Bernie, where does Bernie Sanders fit into this? What's going on? The Republican Party is trying, all of these events serve as potential catalysts and as such drivers for the markets. To the extent, you know, we live in, what should I say, trying times. I'm being euphemistic, but the good news out of all of this, there's no shortage of things that can occur. Will ISIS attack? Should we close the borders? Gun control, all of these events that we're all dealing with and thinking about in day to day could serve, you know, to anyone by themselves or in aggregate together, could serve as drivers for the markets. So depending on, you know, so yeah, I mean, that's, what's the probable signs of next major move? Your guess is as good as mine, but certainly I don't have to have too much of an imagination in the world we live in today, because there's certainly the frequency with which these, what I would have considered 20 years ago to be cataclysmic, the extreme has become the norm in the world today. And as such, that it might be, you know, bad news in the world, what we normally consensus view as being bad, a terrible, you know, a mass killing or something. Clearly these are negative things, but nevertheless, the reactions, the corresponding reactions and responses of the financial markets and the capital markets in particular constantly provide, there's no shortage of great opportunities, and those who are prepared to exploit and interpret them correctly with correct money management, there's great opportunity, and for that I'm ever eternally grateful. I always jokingly tell traders that I coach and teach, it makes perfect, you want to do everything you can to solidify your understanding and your analytical abilities so that you can see opportunities on the horizon and know how to efficiently construct strategies to exploit them. And to that extent, your odds go up, and that's what this business of trading and investing is about. So yeah, no shortage of possible events that can trigger. Great. On that note, folks, I'll call it a session. If you have enjoyed our presentation or if you'd like to review, again, we have recorded it, and you can access our archives by contacting the folks at headquarters, Pacific Trading Academy, again, 1-800-339-8588, or you can look at our website, www.pacifictradingacademy.com. Peter Newman is the person who is Director of Admissions and handles all of the dispensing of information concerning the courses that I teach and the programs and my specialty, as well as my coworkers and other mentors. So once again, I've been happy. Hopefully you got something out of it. And until next time, I wish you a great day and profitable trading in the days and weeks to come.